Going. All right. Hello, everyone. Welcome back to our workshops. And yeah, nice to see you. Nice to hear you. Nice to see your faces first.
Hi.
Hopefully, then to hear you. Yes. Hello, hello. And well, what to do on Friday, almost afternoon, on Central European time, if not speaking about financial models. uh, we thought. And this is why we are here, and this is why we are joining Hannes today into this journey of the most important metrics, financial money metrics, and not so even concerning the money, but concerning your overall state of business and so on. And yes, Hannes is one of our, I think, most influential contributors and mentors. And of course, we are continuing this journey about financial modeling with Hannes. And hopefully, you also saw in Nextword the other materials that we have from Hannes. And without further ado, I think I will just pass the baton to the speaker today, and just say that in case you have any questions, you can post them in the chat. We will have a Q&A section in the end of the content part. Hopefully that it will be, yeah, a very nice conversation about the best Friday topic. So Hannes, the floor is yours.
Okay, thank you very much, and I hope you can hear me well. So before I go into the heavy stuff, so I try to make this for you. So I will go through a couple of content pieces because we need to talk about a little bit of basics, but then I want to go to a more extended Q&A session where we really answer your questions. I did receive a couple of questions beforehand from Irina. I guess you all contributed to that. And so I prepared answers for that, so we can go through them. And I already prepared for you some cheat sheet so that you get the answers straight. There is material you will receive. There are slides, and I have prepared for the questions also a small Word document with all the answers in more detail. And you will receive all this, so no need to write things down other than your thoughts. And yeah, let's get started. Um, okay, so before we go into it, as usual, this one. So, what you will learn today is what is the purpose and the basics of financial model, and why you need to do it. And then I try to give you an overview of what you need to consider in your business case and financial modeling. And then, as said, a more extensive Q&A. I do have an example prepared. It depends a little bit on the audience we have today here. For that, I would like to ask you first whom we have in the room. So, can you give me an indication what industry you are in, roughly? Deep tech, SaaS, EdTech, or whatever. Either in chat or just saying.
EdTech?
AI here.
I see. Okay, we have a couple of deep tech technology companies. Good. Okay, so we have the right audience here. That's good. Deep tech. Okay, a little more deep tech heavy this time. Okay, good. Thank you. And then another question I have to you is, what's your background? Are you more the tech or meta expert? Are you the sales marketing guy? Are you the finance or any other role? That helps me to understand how deep I need to go in this session. So marketing, tech, and more, the standard tech. Okay, so we have a little bit more, I would say, the meta expert technology people here, so that's good. So it gives you a little bit more the basics, so that is good. I prepared this. And then other than that, let's go into it. So some financial basics and modeling and what you need to understand in this whole business here. So we are talking today about business case and financial modeling. This is not the financial statement. That's completely different purpose. And the difference is that a business case helps you to plan the future, while the financial statement is, your back view. So I made here this table to give you an idea of where the differences are. So the business case helps you in decision making, budgeting, forecasting, making strategic investment decisions, versus the financial statement, which is performance evaluation and compliance and stuff like this. And as said, forward looking versus actual metrics. So that is fundamental you need to understand in this whole thing. Also, for sure, business case, budget, forecast, actuals is all connected. And I give you here a little bit how it looks like. You usually start with the business case, so your financial model, what you plan to do financially. And then you derive a budget for that, usually an annual budget for the next year or the next 18 months or whatever it is. And then you have a forecast and actuals, your financial statement, and you check how you are doing against either the budget or the forecast. So that is how all this connects. And your business case is basically your strategic overall plan over the next couple of years. And this is the mid-range planning or midterm planning for your financials. And then all others are usually done in an annual fashion, and the actuals usually you track either monthly or quarterly. So here, some explanations I will not read through. Basically, just how it is basically it looks from the far future to short-term future to near-term future, and then you look into the past. That is how you look at the numbers here. If you have questions, just throw them into the chat or just raise your hand. I will try to answer right away. Okay, so the purpose of financial modeling is to answer a couple of crucial questions for yourself and for investors and any stakeholder in the company who need to know this. And here are the questions to answer is, where's the money coming from? And when does this happen? So, and money comes from either, financing, so you have investments from outside parties, or it comes actually from revenue. Ideally, it comes from revenue for sure. The second question you need to answer is what you spend the money for. As simple as it is, and when this happens. And the when is here the important, because all this needs to come together when money comes in and money goes out. And then a crucial investment question you need to ask yourself is, how long will it take to get my money back, what I'm investing or any investor is investing? So, and then the last one is, and that's more the investment view, you need to ask yourself, and any investor will ask, is this investment has better returns than alternative? And that is usually compared with numbers I will present to you, where investors look at different companies or alternative investments, and then they make an investment decision about. And that helps also yourself to understand, is my business actually viable? Can it survive? Even the best ideas can fail if the business is not viable, and you need to understand this for yourself. Okay, so, and here, very fundamental. What is recurring revenue versus transactional revenue? And transactional is one-time revenue, so-called. And recurring revenue is very simple. You deliver a service or a product in a regular fashion, periodically, every month, every year, whatever it is, and the customer pays you periodically. That's a subscription. I know sounds very basic, but this is fundamentally different to what a transaction is. A transaction is you give a service or a product one time and you get a payment one time. That's it. You cannot expect any money further from this customer other than some assumptions that they may come back. In the subscription, you have actually a contract and they have to pay because you may have an annual contract or a multi-year contract, so they have to pay compared to the transactions. So, and the beauty of recurring revenue is coming from one thing. It is an compounding revenue from your past customer acquisition. So think about, let's say period 1, 2, 3 is a month, for example. Every month you add one customer. So in the first month, this customer will pay you money based on the subscription. In the second month, you add a second customer, and the first customer is still paying. So, and here this black money, basically, this is what is compounding over time. You don't need to basically transact with all your partners all the time because the money will flow in automatically. And that has a compounding effect. And then you will lose customer. So that is this little red one here. These are churning customer. Yeah, black money. Sorry, it's not black money for sure. I see it in the chat. This is money coming in without you taking care about because you have a running contract. So, and then the red customers are customers leaving your service. That's called churn. So they will leave you. This will happen. It's very natural. It can happen because of you delivering bad service, or the company goes out of business, or there is any other reason why they need to leave you. So that is something you have to take care about as well. So, but the point is, this element makes the recurring revenue model so beautiful because you basically have to take care about bringing in new customers, and the money flows then mainly automatically from your contracts you made in the past. Okay, so I have a question to you, and please speak up or give your answer. So a local pizza shop has declining revenue. The owner asks you for help. What you would do? That's a question, very famous question from McKinsey. Some of you may know the answer here. What would be your answer to this owner? Okay, the answer is pretty simple. There's only one way to answer this. What does the revenue look like? And the revenue is made out of the price you earn versus the quantity you sell. That's it. Revenue is only that. And there is only one question you need to ask is, what is making the price go up or down? And what makes the quantity go up and down? So I see the answer here, reduce the price and smaller portions. That is one answer you can make. But maybe there is another problem in the business. So you need to deduct basically the answer here. So the question to the local owner of this pizza would be, okay, what is the price compared to your competition? So do you have higher prices, lower prices than them? How many quantity you sell? How many competition you have actually? How many people live around you? So that will all influence the quantity. So the answer is not necessarily to reduce the price. It could be also to think about how I can extend the quantity. For example, if this local shop does not deliver, that could be a new way to increase the quantity. You have a delivery option in future. So you need to think about these two components very, very carefully, very, very deep. because this is the answer to this question. Why it's declining? It can be only the price or only the quantity. So for sure, there is more behind that. And this is for in our business, ARR business, and recurring revenue business. This is how you look at it. So your revenue is made up of quantity and price. The quantity is usually your number of contracts you have with your customers. You can call this active customer base, you can call this active contract base, whatever. So this is your quantity. And then you charge a price per contract. That's the value of your contract. So ARPU is the average revenue per unit. So whatever unit you have and you sell, that is your price. And then you can see how this is influenced. So the contract base can be influenced by how many new customers I get, how many contracts I have in average with customers, and how many are leaving me. And then the average contract base there within you may have upgrades, upsells, downgrades. You change your contracts with your partners. So this all influences your contract base. And then you have within the churn, you have to look into activation rates. So if you are doing SaaS, look into the first 90 days. If the customer is not using the service, that's a very early indicator that this customer will churn, period. It will happen on some point. Also, this is here from the example I will show you. So look into the usage patterns. So if you, for example, if you are in the backup business, you look into how many devices are backed up, how much gigabytes are consumed, etc. If you are in deep tech selling compute power, look into how much compute power is consumed, etc. So and then there is one indicator. It's already a past indicator, but when somebody tells you, hey, I need to cancel our contract when it ends in 1 year, you already know this. So that is a very early indicator for something is going wrong in your customer base. So, and then for the ARPU, that is all about, what are the different mix effects I have. So mix effects can come from, geographies. If you are selling in the US and India, for example, obviously you will have different prices. If you sell more in India, your average will go down because usually they are more price cautious, and you have to adapt to these prices. So if you sell more in India, automatically your ARPU will shrink without you doing bad business. It's just the numbers here. Also, when you have different plans, basic or silver, gold, platinum plans, as an example, the mix of those will make your ARPU impact. If you are able to selling higher priced services, that will bring up your price, and so on. I can go on here. This all will impact your price, and you need to deeply understand where it comes from. So not necessarily shrinking ARPU is bad. If you are selling in India 10 times more than in North America, that's actually good. So because your quantity is increasing like hell, while your ARPU is maybe shrinking, which is fine because in overall you will make more money. Any questions to that? That's, I know it's can be a little bit heavy. Okay, let me move on. So how you build actually a business case. So there are 10 elements you have to think about. And you, in an ideal world, you do this in an Excel table because that's the easiest to do. First of all, start rough and go into details with iterations. I always recommend this. So start with your basic assumptions. You want to create a service. You have one package. You sell this for price X. That is your starting assumption. And then you go into details of, okay, may I have more more packages I want to sell or different services. Market. Understand your market. Where are you in? What is your addressable market? What is your reachable market? There is a difference between, I want to sell to the whole world versus this is the group, the most sticky group I can reach with my network, with my product, with my service I offer. For example, if you solve a very specific problem, um, like being more efficient in work and you targeting the whole world, think about, okay, who benefits the most and who benefits the fastest from your solution? Because that is the sweet spot of where you need to go first, because you need to start somewhere. You can't attack the whole world. It doesn't work this way. So, and then based on your understanding of the market, define the offer, set the price points, and identify your costs to deliver. That is super important. So, and then revenue. Revenue is a big topic. The revenue is a number, right? Every month there is money coming in. So, but your revenue is made out of the incoming orders you have, and in deep tech or in B2B SaaS, usually you have ramp up times. So you need to take this into account. So as an example, if you targeting enterprise, take into account it will take 6 months, for example, to onboard a customer. So the full revenue of your contract may come in 6 months, and in the first month only 20% of it. So you need to bake this into your plan to understand when a revenue is actually happening. Also, think about what additional services, additional add-ons you can sell, and how the adopt rates will be over time. So if you start with a basic service in enterprise, you may be able to upsell them in 1 or 2 years another service. So take this into account. And again, revenue is what I just showed you, price by quantity, and that will drive your number here. Fourth, the gross margin. Revenue minus COGS. COGS is the cost of goods and services, goods sold, sorry, divided by the revenue. And the COGS is basically what the cost is for delivering the particular service. So I will go into this because there was a question about this. I will go into this a little bit more deeper later in the Q&A session. So be aware. Okay, gross margin. Then what is your customer acquisition cost? So, and that is marketing and sales cost. So think about what will it take you to get a customer signed, and this can be a range of activities. Either you have a salesperson going into the network. I'm thinking about healthcare, for example. In healthcare, usually you have a salesperson going to the different hospitals or to the doctors. So that is cost you need to take into account. Also, this person will need to travel because usually it's a very in-person business. In other activities, in other businesses, it's maybe events you need to be, industry events, or stuff like this to be present in the market. Or you do an online marketing, then take into account all the costs for this activities. So basically, take into account what it costs you to get a customer. And that for sure is what will drive the customer acquisition costs. And then on top of the COGS and the customer acquisition costs, think about all the other general costs you have. So you have personal costs. So you need to pay salaries. Unfortunately, you need to pay for travel of people, etc., etc. And all this general costs and legal fees can add up here as well in your case. So these are general costs. they come on top of your COGS, your customer acquisition costs, and that is basically what I explained to you is the EBITDA here. So the revenue minus the COGS minus CAC minus the general cost, that is your EBITDA. And EBITDA is your earnings, your profit before taxes and the depreciation. So, and yeah, the next factor is calculate the EBITDA. So as explained, very simple calculation. When you know the cost, you can get the profit. So in CapEx heavy environments like deep tech, where you need to buy hardware, for example, this cost um, um, is taken out from the EBITDA. So basically the CapEx cost, and that is cash contribution here. Whatever you invest into hardware is usually depreciated in our business for 3 years, 3 to 5 years, depends a little bit on the hardware. And but you have this cost upfront. So that's the whole point here, right? So you have to pay now, and then later on you get the outcome of that. So this cash contribution is a very important measurement for the KPIs you need to have for investments. And I will show you this in the example. Okay, and then based on that, you calculate the net present value. And what this is basically whatever is left end of month, and then you predict for the future. You calculate back, okay, my future costs and profits, how they would worth now. So that's a net present value. I will explain in a second in my example. So, and then that is the last step is compare the investment with other investment opportunities. So, and here, very simple. If it is better to put your money into a savings account, then obviously something is not okay with your financial plan, because then I would go to my bank and put the money there. It's just less risk than investing into the company, you know? Okay, so how it usually looks like is this. You will get something like this. You have to invest money upfront, and this can be this number can be very significant upfront in deep tech. For example, when you have to invest a lot into development of the technology, and then on some point you go to market, and then you actually start earning revenues. That's a green line. And then on some point, your revenue is paying the costs you have. So that is what is called the break-even point. And then in another point later, that is when you get back all your investments covered by the revenue. That is when you start becoming profitable with your investment. You start here to becoming cash flow positive at the break-even point. But at this point, your whole investment becomes positive. So that's usually when it gets exciting for investments. But again, this graph here highly depends on the business you are in. So in deep tech, usually you have a lot of upfront costs. So you will see like this, and then you will start your product launch, and then slowly you go up to the break-even point. So that is usually what you will see. So, and then as you can read, there are a couple of main drivers for the net present value. Before I go into this details, let me show you actually the example. And please feel free to ask questions. So you can see my screen, I hope. So that is a real example. It's a couple of years old, but doesn't matter. That is an investment case for a backup solution. So it was for Cronus, I can tell you. It's now more than 7 years old, so it doesn't matter too much. The point here is that is how we look into the business. And behind this small table, I explain in a second, there is this huge table. And I show you, no need to go into the details here, but in essence, what it does is it goes month by month by month what the numbers are, and as precise as possible. And this can be very small table. No, don't be afraid about this large table. You can start very small in thinking about, okay, how many customers I will have on some point, how many different packages I sell them, or how many hardware I will deliver to my enterprise customers. All this you can basically plan out, and then this will give you the unit numbers. So let me go here and let me do this way. It's maybe easier to consume. So basically, all this here is to understand your average customer base. So the quantity of your revenue. So how much of my product is sold. The second piece is to understand the revenue out of it. Usually, you have, when you are in B2B SaaS, you start with packages, silver, gold, platinum, whatever. Or if you are in deep tech, you sell per compute or per output. So, and this has a price. You need to price this, right, in whatever way. And then you just calculate what's your customer base multiplied by those prices, and this is a revenue, as simple as it is. So that is usually the heavy part, where you need to really think about, okay, how I will sell, how this will work, and how I need to price this. And then the rest is just math. And then you apply to your unit economics the different costs. So, for example, you have a package ABC. To deliver package A, it cost me X amount, right? And this amount is maybe higher in package B, because there's more storage, more compute I need to put into whatever is the real driver for this. And you calculate this. So that's your COGS, because this is driven by what you are selling, the product. So, and on top of it, you have the cost for sales and marketing. That is usually a mix of unit-based measurements, where you have basically, you say, okay, to get a customer, it will cost me this. And then you have on top marketing and sales cost. For example, you want to get the word out of your company. PR usually is something you will do, public relation. You will tell people about your solution, right? And to do so, you need to hire people, you need to hire agencies. This is marketing money in the end. So, and take this into account, and that's your sales and marketing costs. And then on top of it, you have all your general costs. This includes personal costs. This includes general costs like legal fees, or if you have HR agency, whatever. This goes into this number, and then you can calculate the EBITDA, which is basically the revenue minus all the costs, and that's the EBITDA. And then on top you have the capex. So, and capex is the investment into hardware and stuff you can depreciate over time. Usually in our IT business, this could be hardware. This could be also R&D developments sometimes. So if there is an R&D heavy development, where you, example, you are developing rockets, right, to shoot into the universe, then you buy the hardware, and you need to buy those test rockets. And this costs are usually capex, because all the effort you put into this test rocket, that's actually capex. So that goes a little bit into the accounting piece here. Sometimes it's not 100% clear if it is costs or if it is capex. So cost means opex, by the way, operational expenses versus capital expenses. But your financial accountant will tell you for sure. So, anyways, yeah, the point is take this into account, and then you will get to a number called cash contribution. This is basically your EBITDA, and in the beginning, this will be always a minus number for sure, because you have to invest first before you see revenue, and this is the cash contribution every month. So, and then you can add up this to an annual number, and then you get something like this. So, and here, this is, by the way, also the KPIs you should focus on is in SaaS business, as an example, what's your customer base by end of the year? What is your main driver KPI? In this case, it was storage. So storage was a main driver for cost. So you want to understand where I am with this main driver in every year. And then you have the revenue over time and the different variable costs. So that is what you calculate. And then the other ones are just math calculations for the rates you are in. So, and what you want is, you want an increase in the EBITDA margin. Obviously, you want to become profitable. And then all the other costs should go down. That's your goal. And this is as a percentage of revenue, basically. So your cost of goods sold is usually a stable number because it highly depends on your delivery, on your service, on what you sell. If you sell a rocket, this rocket will cost money every time you sell this, right? So this is usually a very stable number, and it levels on some point. Sales and marketing and your personal costs should go down because with more revenue, you're not adding more people or adding more sales and marketing. You are leveraging the productivity those people have. So that is a natural thing. It should happen is those things go down. So, okay, now coming back to the net present value, because that is something to understand. The net present value is what you calculate in terms of your future profit and cash flow. So, in the future cash flow, here in a very simple example, you get every year 10,000 US dollars as an EBITDA, as a cash contribution. Every year, 10,000 US dollars. This 10,000 US dollars, we assume here that this 10,000 US dollars have an interest rate of 10%. That is what this number tells, 10%. And what the NPV does is it calculates back the future value of this. So the 10,000 US dollars in 3 years worth less now than the $10,000 in 1 year. That's what you will get. So your 30,000 US dollars you earn over a time frame of 3 years, earn today roughly 25,000 US dollars. So, and this is basically calculating all the future back to today. And this number is super important because this tells you if your NPV over your time frame you're looking at, 5 years, 7 years, 10 years, if this is positive, it indicates that your business is viable. A negative in NPV is a super red flag because it tells you that your business is not viable. There's something wrong in your assumptions. Either your price is wrong, your unit metrics are wrong, or your costs are too high, whatever it is, but this is a red flag for sure. And then you have near zero NPVs, where it tells you, in 5 years, I can break even, my investment plus minus zero. That can be okay in some ways because it depends on the investment horizon. If you plan for 3 years or for 5 years, your investor may plan for 7 years. So it's maybe okay for them to see a zero NPV if they think that after that time frame, it will go up. It depends. Okay, I will stop now for a second because that I know is always a little bit heavy stuff. Questions? Or did I lose you already? Okay, good. When you know the NPV for your case, you should do a sensitivity analysis, also called scenarios. Usually you do 3 scenarios: a base case, a worst case, and a best case. So, and you need to understand what the sensitivity of your NPV is and why this matters. Worst case and best case, here's an example. You make assumptions like 10 to 20% less customers. It takes longer to onboard them, or you get less price, less revenue. So these are typical parameters you would take into account to define your worst case. On the other hand, you define your best case. Hey, what if I can deliver with less cost? If I have more customers getting in, or if I can make a better pricing with larger customers. So that's your best case. And when your NPV reacts very heavily to one of those assumptions, then you know that your business case depends too much on it. When you say I have 10% less orders, for example, and your NPV turns from positive to negative, then it means that you are too dependent on your customer numbers. So you need to think about price. You need to think about what other target groups I may have. That is a good indication for that. If it is in a range of the base case, worst case, and best case, and it's not super variable and not going up too much, it means you have a solid model because it doesn't depend on one or another thing too much. And what you want is that your worst case is still positive. Even though it's not good, it may still positive because that tells you, I am resilient for, uncertainties. That is what it tells you. Okay, so there are further readings. You will see this when we send out this, so I will not go through. And now I want to go into the questions you asked me. And please, first of all, are this the questions you have? And do you have other questions? Maybe. Please drop them in the chat or speak up. Okay, good. So one of the questions was how to model ARR and cash flow. So I will jump now to another slide here where I try to answer all these questions in more detail. So ARR and cash flow are different beasts, period. So ARR is how big this can become. That is answering this question. The cash flow is answering the question how long I can survive. So when I am running out of money, that is basically the question you get here, or the answer you get. So ARR basics we just discussed about, I will not go through again. So it depends on your price and quantity. And then for the cash flow, what matters, what you need to think about is when I charge them actually, do I charge them every month? Do I charge them annually upfront, which is the best? You want the money as early as possible for the service you deliver, or any other, or is it quarterly as an example? It matters because this is when you get money. Payment delays. Take this into account. In B2B, you have payment delays between 30 and 90 days. Even if you send an invoice today, you get the money in 3 months. That is, you have to think about this and you need to be able to cover this. Otherwise, you will run out of money suddenly because somebody is not paying, you know? So revenue is not cash. That's also very important to understand. When a billing invoice is actually sent out, you get cash when the money arrives your account. It doesn't mean that's the revenue. The revenue, if you, as an example, bill annually, you have to divide this by 12 because every month there is a revenue associated with it. So 12 months, 12 times the monthly price, that's the cash versus the monthly price is actually your revenue. That's accounting. Your accountant will tell you how this works, but have this in mind, revenue is not cash. So, and then usually you track this monthly. Okay, so another question was how to show clearly on-off not recurring revenue to investors. So, very simple, never mix up one-time revenue with ARR. Different things. When you have an ARR number, which is active customers multiplied by the contract value, the annual contract value, that's ARR. And one-offs are happening in a specific month, as an example, or at specific times, and they are not recurring. So it means just leave them out and separate them into your plan. So you have recurring revenue, that is one number. You have one-off revenue, setup, hardware you sell, whatever it is, or professional services when you help your enterprise customers to integrate with your solution. And that is what you want to show very specifically. And then what investors want to see is that the percentage of revenue that is recurring is growing over time. So you are not dependent on the one-time revenue. And the one-off revenue should decline over time so that you are becoming less dependent on those one-time revenues. So, and this can be significant stuff, right? Back to my point here, selling a rocket to somebody, that's obviously one-time revenue because afterwards the rocket is gone, or at least only half worth if it comes back. And but what you may get is a monthly retainer fee from your customer to deliver services around this rocket. That's a made up example for sure, but you know this is how it works. So and then for you to understand, one-off revenue improves your cash situation. It will not help you in valuation. Valuation is made of AR only, mostly. Many investors are looking only on the ARR number, and they put a multiply on the ARR number. How we are doing on time, Irina? We are still good, right?
Yeah, we're still good.
Okay, good. Okay, let's go to the next. Simple 3-year financial model. As laid out, step 1, divide your revenue into different revenue engines. Split them by subscription-based revenues, split them by whatever other engines you have, even the one-offs, and model this out in different engines because each engine will have different drivers. Your subscription business is based on your price, the packages you sell, the mixes, blah, blah, all what we said before. Your second thing, usage or rev share models, they depend on the rev share agreements you have. You make assumptions, 20%, 10%, whatever rev share you have with your partner, that is a completely different driver. Because if the rev share goes up and down in future contracts, that will drive your revenue, not the packages in the subscriptions, you know. And then one-offs obviously depends on the time when you sell stuff and what your assumptions are. So the driver is the number of one-offs, you know. So split them, separate those engines by the different drivers, as stated here, and then merge the revenue only on P&L level. So on P&L level means bring those numbers only together on the total revenue, where you then say, okay, this total revenue is made of subscription revenue, usage or rev share revenue, and one-off revenue. So that is a very clear view on how to drive this. So, and the last one is what matters the most in the metrics. So, depends on your business you're in. So, in SaaS businesses, usually what you will look at is ARR growth, gross margins, retention rates, so how long your customers stay with you. You look at the costs you have to acquire a customer and how long it takes to get back the money. So that is called CAC payback. And then you look into burn rates. So how long my money lasts, when I will become profitable, stuff like this. In the B2B to C business, this is channel business. Basically, you go through a partner like a reseller or distribution partner. So the partner take rates are interesting. So how much they take from you for different partner types. The end customer revenue. So what the partner makes, and then minus what you give to the partners. So that's the rev share model, for example. Then you have usually a blended customer acquisition costs, which means you need to pay partners to acquire their customers. That is usually what the channel play is. So you need to take into account the cost you have with the partner. I give you an example. Ingram Micro, very large IT distribution company, and PAX 8 in the IT service business. They are very large distribution partners. But to be on their marketplace, to be in their ecosystem, you have to pay them actually money. So it's a pay-to-play game here. So, and this costs you have to take into account as marketing and sales costs. So, and in deep tech, this is usually very capital intensive. So biotech as an example, you invest a lot upfront before you see outputs. So usually investors looking at how the capital needs are going over time. So what's your burn rate, and then how long it takes to get positive. So, and I give you an example. Some deep tech technologies, they only will be profitable on a certain size and scale, And the question is, when is this scale reachable? That's usually a question you would ask as an investor. Okay, so there was a last question about, and I did not put this into the slide because this was a little bit too heavy slide already. So, COGS for deep tech, that was a question you had. So usually what you would take into account is the R&D costs. So what it costs me to develop stuff. But you also need to take into account what does it take to deliver the service, your product. So you have compute usage, you have hardware depreciation, you may have model training costs, data acquisition and labeling costs. All this you need to take into account. And then what is not COGS is your research, your long-term research, corporate management, G&A stuff. So rule of thumb here is if it is attached or scales to the customer, then it's COGS usually. So have this in mind. And again, I will send this document as well, so you can read afterwards. Okay, so to summarize, ARR, cash flow, and one-offs are separated. Keep this in mind. Revenue is driver-based, not wish-based. Have this in mind. I saw a lot of plans where there was wishful thinking. how many people will buy my solutions, but try to understand the real drivers. What is really driving your business? So recurring revenue shares improves over time. That should be baked in. If not, think about your plan. You know, be honest about your costs. Be more conservative with the costs, um, rather than trying to hide real costs. And then make it visible what is happening. So what investors will always appreciate is when they understand what is coming and what is the plan, rather than nice numbers going up very fast. That is not what they're looking for. They're looking for, okay, what is actually your plan and how you are doing against this plan. So, and if you can show that you are on track, even you don't make money yet or you burn money, that's fine, as long as the path to profitability is clear and visible to them. Okay, and the last one is this one. You will see that the ARR can be calculated in different ways. I just mentioned this. You can read later on about this. You will see that ARR is the monthly recurring revenue multiplied by 12. And sometimes you will see active customers multiplied by the average annual customer value or contract value. Both is not wrong. You need to apply in your certain situation. It depends. In our business, usually B2B SaaS, B2B2C, deep tech, you go with the second one because that is more accurate. So that you should know about. The rest you can read yourself. Okay, good. So there is one more question. Maybe you have some insights on building token-based models, subscription plus usage token insight, for example, which approaches are the most useful. So, okay, not so tricky. So what you would usually do is, let me go here. You usually do have different packages. In your case, it's maybe a subscription. So, and you have a price attached to each of the subscription. Included into this package, you would do a number of tokens, 100, 200, whatever your unit is. And then every over usage is charged for. So you have token included, and then on top, whatever is used, it's charged. And you build this in a way that the charging for additional tokens is more expensive in the smallest package than in the largest package, because this will drive people upwards. People will calculate in their heads or with a calculator that it is more cheaper to go to the next larger package with more tokens included, because when the usage is happening, it's less expensive. So build this into your model. I can give a whole different session on how to build packages if we need to do. I can offer to do this. Reach me out, please, for that within our Constructor Start batch here. But to your question, it depends a little bit. I would go for a hybrid system, to be honest, because subscription plus charged for usage is something you should consider, and put an included number of tokens into your package. I hope that answers your question. So, Ivan, you have a question.
Yeah. Hi there. First of all, thank you very much for your time and insights. Can you hear me?
Yes.
Oh, great. And to this point, because we did an analysis, because we're doing an AI assistant, and a very good insight that we learned that from 40 to 60% of your margin will go to paying for the tokens. So I think that's the main method you need to make while building up a price for your fee for the subscription. If you leverage OpenAI or any other API, cloud API capabilities in your market. So that was another interesting question that I had. But as for my question, and I think it might be very useful for many of us here, as we specifically are in pre-revenue, like with basic beta user traction at the moment. And given we all here are targeting to build up a proper pitch to combine from all different building blocks, and financial model and monetization strategy is obviously one of the things that we need to speak about. My question would be, what would be your suggestions as what are the main aspects, what are the main building blocks that investors want to see in your financial modeling when you do have little traction, you do not have any revenue, but you need to show that you did any forecasts. So you can assume that you might have X amount of users multiplied by X dollars that you will ask for your services. You'll get some kind of revenue. You can calculate the cost of keeping your team and somehow come up to the point where you break even. But what else? Or maybe I am taking it too far at this point. So again, pre-revenue financial model, what would it be in your opinion? I would appreciate that.
Yeah. So let me answer twofold here, because your first question or your first remark was a very important one. So thinking about token and the costs attached to it. If you're utilizing ChatGPT for your product, this is a main driver for your costs in the future, period, right? So what you want to show is how you can become independent when the company becomes successful. So, and this is called the ownership of bill of material. Because if you are dependent on a third-party solution and you build your whole business around this, you're very vulnerable. Because what happens is then on some point, ChatGPT will just increase their price and your model will be screwed up.
And they sorry to interrupt you. And they already did yesterday's announcement of their 5.2. Right. They increased 40% in price for their tokens. So that's crazy.
Right. Exactly. So what you want to show, if your model is highly dependent on a third-party service, you need to show them in the next 5-10 years, when this thing becomes really successful, how you can become independent from this third party, because that will make the break or make it decision, you know? So do you have a plan in place to train your own model, as an example, a specialized model just for your purpose? So it doesn't need to be a general model, as an example. So think about it. I'm not giving you the answer, but that is a very important question to ask yourself. And that is why you need to understand your unit economics. If every additional customers just drives up the cost for your ChatGPT, your model is likely not super viable, you know, because it will break. And then make the sensitivity analysis. What happens if they do another 50% price increase? Will your business go out of business in this case? So think about. So, and to answer the second question you had, so what to show pre-revenue, what I would do is be honest to yourself and to your investors about the path to revenue and profitability. So, and then here, back to where I have it. Give me 1 second. Yeah, this one. So, show them realistic numbers, ambitious but realistic, and explain them. So, why you think you will have this number of customers in end of year 1, or why you believe that my cost will be this, and why you believe the trend will be this. So have a clear explanation and be prepared. So what you usually show is this here, right? That's it. This is what you show in your pitch. But if an investor is asking you, be prepared to go here, to go into your Excel table and explain them why this number makes sense. Because here in this number, as an example, give you an example, there's multiple assumptions included. It's an assumption we will go into more markets. We attract new customers, new customer target audiences. Have this answers ready. Why you believe in this number? Be ambitious. Don't be too conservative, but be clear about it. And also be clear about the path. What are your goals? What is your timing? So, and here back to this this one. So, when you expect go live, when you expect to be out there. So, and what is the path to be there? Let's say you need another 18 months to be in the market. Can happen easily in healthcare tech, for example, when you need to be compliant to something. You need to make this regulatory stuff. So it will take time. So, but here important would be, okay, in the next 18 months, in 12 months, we will have the compliance certificate number A, B, and C, or we will be ready with our MVP and we have the first 10 customers looking at it, or pre-customers who help us to develop it. So that would be something I would point out. So what is your specific? And this is usually where it becomes a little bit messy when you need to show, okay, in the next 12 months I am not running out of money, and the money you gave me will give me is enough to cover this, and here are the milestones to achieve. And those milestones are usually in our industry technology milestones, or regulatory milestones, or having first touch points with potential customers, and real touch points. Real touch points means, for example, you partnering with a larger partner to co-develop something, because they are super interested. So they may not pay you, but they was that much interested that they spend resources together with you to develop the product with you. And in deep tech, for example, again, could be regulatory stuff. If you go into legal AI or stuff like this, then you need to cover certain regulatory stuff. So to your point, I would be very, very clear about what are the milestones and stick to them. I mean, as simple as it is, right? And if you are delayed, be honest to yourself and don't hide it.
Yep. Just one follow-up, if I may. So, but basically, just for the base, saying that you have this amount of marketing, that you're like fundraising this amount of money, let's say 50K in dollars will go to marketing over a span of like the next 12 months. And you can expect that. We can expect some virality. We can expect some social media platform that you can do it like for free. You can have this budget for marketing. You can build up some amount of users that you can bring. You can calculate how many of them can be paid users. You can multiply it by the fee that you will ask for the service that you provide. And is it like good enough for this time being? Because again, this is all our projections, but you need to take something and build up the story like from some exact amount of money. As in my case, let's say the budget for the marketing split for the next 12 months, plus some extra factor of virality that your product can get.
Yeah, here's a caveat. So you don't know the costs because simply you don't have customers yet. So what is more important is to understand what the true cost will be. So in your example, I would rather spend my time and money on getting real feedback as early as possible. And then you will understand what makes customers or potential customers decide for you. And then you can think about, okay, if they, for example, if they decide about technology or solution in a certain way, they go to an industry event, or they hear from their peers in the hospital, whatever it is, then you understand where you need to be. You need to be in industry events, or you need to be going to hospitals, as an example. So to understand this is more important than laying out now the budget for 12 months where you don't even know if what your true costs are. You simply don't know it. And because of you don't know it, spend time and effort in understanding it rather than trying to lay out something it will fail. Not fail, but it will be wrong one way or another,
Yeah.
either too low or too high. And it's not your fault because you simply don't know it yet. And pre-revenue means you try to understand what makes your customer buy in future. If that makes sense to you.
No,
It
no,
doesn't help too
absolutely.
much, I know, but
No. Yeah, the hard question is that investors always ask like how much money you need, how much money do you need, and when will I get them back? And you need to say that I will use your money in this way. This will let us bring in that many users. We'll ask them to pay like that amount of fee, and this can build up like you to the point where you can say that I can get your money back like in 12 months after the investment and
yeah.
things like that.
So I don't know what your startup is doing, but the point is, to be honest, I would not spend money in digital marketing in the first place. What I would do is I would spend money in activities helping you to do the first deals in your network. So because your early customers will come out of your network or your investors network, and you spend time and money on getting them. So either by giving them good discounts, or you travel to them more times, or these are more the costs you take into account, because your first 10 customers will be out of your network, and you should think about what is called lighthouse deals. Lighthouse deals are those deals where you try to get one large partner as a showcase for other customers. Specifically in B2B and B2B2C, you want to get those larger partners first, and this will be relatively costly because usually you would give them the product for free or for high discount, and you spend a lot of time with them. So that is likely your real sales and marketing costs at this time, in the early stage. The other ones, digital marketing, etc., it's not super efficient, to be fair. Very specifically in early stages.
I think
It's more
it's
word of
highly
mouth. Yeah,
So sorry, I think it's highly depend whether you do B2C or B2B, because I guess in
that's true.
B2C you're very, very dependent on marketing.
That's
And
true.
in B2B, exactly what you told. And yes, so the first few customers will basically build up of
Yeah.
how successful you can be.
But
Right.
B2C is another game, that's true. And B2C and also B2B, by the way, think about the cheaper ways of attracting people. And this is community work. So invest into Reddit, in somebody who answers Reddit questions, or is present in communities where they are, so this is what I try to say is more the word of mouth, how you can accelerate the word of mouth, and that is maybe something to think about. But
That's
this goes more now in the marketing session. I
true.
think we have a specific session on that.
Yep. Thank you very much.
Yeah, you're welcome. But I know there is no clear answer to this question, to be fair, because it highly depends in what market you are,
Mhm.
in what target group you try to attract, and what sweet spots you are. And if you have a very strong network, that will help you. If you don't, you need to find other cheaper ways.
Yeah.
Now, that's the truth. Okay,
Okay.
good. Any other questions? Okay.
So, any more questions or comments or something that you want to go? Okay, I see Musa unmuted. Or Musa? Okay, maybe I just don't hear, or maybe it was just a technical.
Okay,
something.
so but no problem. If you have questions after the session, please reach out to Irina, and she passed the question to me, and I will get in touch with you. No problem. No, Musa, we can't hear you.
Yeah, no, we can't hear you, Musa, but you can probably, I mean, if not, then ask a question in the chat, or if it's not too much, let's just wait for a
Yep,
bit.
we wait for
But
you.
yeah.
No
Yeah.
problem.
So, but nevertheless, thank you so much, Hannes, for also preparing the material that you feel is crucial for for the founders, and also answering the founders' questions together with all the checklist, I would say, information. I think that's very valuable in order not to get lost in all the heavy stuff, as you call it.
Yeah.
Yeah. So
So, and
let's wait for.
last recommendation for you is really start with an Excel table and go month by month and think about what will happen this month, and that will help you to lay out the details. And you can start easy. No need to get into big tables. Just understand what will happen every single month. And if you have enough time, which you will not have, but you can do it even by week. To set your own goals for the week. But that's more more hypothetical. Okay.
All right,
So it
maybe
looks
we
like
will.
Musa has a little bit technical problems, but no problem. You can send
Hmm.
note to Irina,
Hmm.
and I can answer
Yeah,
them.
yeah, and I will forward. So, yeah, or if possible, I mean, we can just organize even the call if there is a very huge something to be discussed, and probably it's better to discuss it one to one in that case.
Right. So in
Yeah.
in the material, you will find my contact information and some other slides I put there for a little bit more info if you want. And with that, I would say we close the session.
Perfect. Thank you so much, Hannes, and thank you so much for the engagement from our brilliant question makers, the founders. I will send shortly also the recording and all the materials and the feedback form to ask you how was it for you? Maybe after the digestion, it's actually better to kind of go into that again and again, and maybe in a loop, in kind of a loop content. Yeah, content learning. And well, we are finishing up week 5 and moving on for the last week of this year before the winter break, which is week 6. So see you next week on Tuesday, and then we're going on the well-deserved Christmas break. And yeah, wishing everyone a very nice weekend ahead and productive one. And you know where to find us if you have any questions. Thank you so much, everyone, and see you around. Thank you.
Sure.